My name is Ahsan Ali and I work for Khalifa Fund. Um, Most of you would be familiar with Khalifa Fund. We focus on SME entrepreneurship development and we invest and lend to SMEs within UAE.
Thank you. I'm Chandra Tiwari, currently working with Aramis Partners, a fund, DIFC-based fund, looking to invest in regional companies, mostly on the private equity side.
My name is Mustafa Kariba, and I'm the Chief Operating Officer of Abu Dhabi Financial Group, an alternative investment firm based in Abu Dhabi.
Hi, my name is Abdallah Shaheen. I work as a managing director in Gulf Capital, which amongst other things has a private equity practice focused on the GCC region.
Great, thank you very much. So the first question that we really want to ask you guys has to do with your, what is it that you do? What is it that you don't do? Really from the point of view of what is your investment strategy, what process do you follow, what sectors do you look at? So, and also what do you not look at, what do you not do? So maybe we can begin with you, Abdullah.
Sure. So we're focused, as I said, on the GCC. We also do the peripheral areas like Egypt and Jordan. We focus on well-established, profitable businesses that we can help grow and take to the next level. And that can come either through capital injections or a combination of capital injection and a secondary buyout where the entrepreneur cashes out as well. And we work hand in hand on backing a strong management team and the entrepreneurs in growing this big business and taking it from the local market into the regional market, and if it's the regional player, into the global market. We like to focus on the consumer story. We shy away from cyclical businesses or government businesses that are heavily exposed to contracts. That's really it. We don't do turnarounds or distressed situations. We unfortunately don't do startups or what we call venture capital early stage. So we come at a later stage within the cycle, more towards the growth stage or larger transactions. So if there is no revenue or if there's an unproven business model, then that's going to be very difficult for us to get our heads around.
I think he pretty much covered the whole spectrum there, but for us at Abu Dhabi Financial Group, we're kind of a different beast. So when I said we're an alternative investment firm, it's not only in our philosophy, but in the way we do business. We don't focus predominantly on private equity. On the contrary, it's a small piece of our business. We look at multiple aspects of the investment horizon, and we focus actually on three specific silos: financial services, real estate, and more recently, technology. What we would look for is opportunities where we as a firm can see that we can add value. This is very, very important. I was speaking to the panelists earlier and said, we don't do automotive industry, for example, because number one, we don't have the subject matter expertise. We don't have the hands on deck that are able to provide additional value for that sector. And as such, we like to focus on areas where we actually can bring value to the investor and to the company itself. And we invest in different forms throughout the whole entire capital stack. We can do equity, we can do preferred equity, we can do mezzanine debt, we can do senior debt. I mean, we can help in the entire capital stack.
Sure thing. So our strategy is also very similar to what Mustafa and Abdullah sort of highlighted, that we look to invest in private companies here in the region, which are profitable. And we believe that we can invest and grow the business further from our perspective. And we also are flexible in terms of both private equity as well as high yield financing. So we can look at a structured finance or private equity transaction for our sort of potential partners.
Okay. So what we do is what these guys don't do. We focus on the startup space. So a good example would be if you wanted to produce a 100-meter running champion, you need to have enough kids, you need to have enough babies, shortlist 10 of them who will run and get to the champion stage. So our job is to have think of it as us as an incubator. We operate in the startup space. We have lots and lots of babies, and some of them grow up and become their customers.
Thank you, gentlemen. That's very clear, and I'm sure our audience has a better idea of what private equity does and doesn't do. It might help to bring it to life a little bit if we can have an example of one of your invested companies, maybe somebody who you took into under investment, somebody that our audience would recognize. Could we start again with you, Abdullah?
You want to mention an example with names, or?
If it's sensitive, you can tell us the kind of company.
I
or
think
the
it's always
nature.
sensitive, so let's stick with no names.
No, I think I have a relevant example given the subject matter of the forum here, and I guess you can classify this specific company within the SME space, and they were having they were your typical SME, undercapitalized, no bank would give them any financing. They've been forced to only deal with customers that can pay them cash in advance, and suppliers were not giving them any credit terms. So this was, and it was a company that's been in existence for 11 years, right? And it's doing very well. And we invested in them about a month ago. I mean, it'll be announced in 2 weeks, but just the majority of the money that we invested went in terms of a capital injection to support the business. And this way they will be able to, one, not struggle with cash, and kind of they can be able to offer their customers credit terms. They will be able to negotiate with their suppliers. They'll be able to have better and more comfortable inventory levels to serve their business and their customers. And also banks, all of a sudden, now that they have a PE corporate within the shareholding structure, are happy to lend them support and give them working capital. And the reason these guys partnered with us is not because just the money, right? Money is one part of it, but we actually knew the space they were in quite well. And we had a lot of expertise having invested in two companies that are in the similar space. So we felt, and they were convinced, that we can bring a lot to the table besides just money, whether it's enhancing your management team, looking at how you do everything from ERP to customer service, to how do you structure yourself, as well as kind of bringing in global industry experts into this business in preparation for an exit. It's very clear every time we do an investment, the entrepreneur or the founder has to understand that we are not, and he cannot be emotionally attached, and at a certain point, we need to exit, because when we raise money, we promise our investors to give it back to them, hopefully with a handsome return. So that's my example. I hope it helps. It's more relevant.
Would any of the other panel members like to also?
So I'll give you an example of something that we've just recently done. So following with when I spoke earlier and said we do things in certain sidelines. So we got approached by a software developer or a software company per se that does a specific type of software that helps real estate developers, asset owners, and portfolio managers effectively and efficiently manage their portfolio. So this is something that was very clear to us, that we have a large stake in real estate developments and real estate assets globally. This is something that we can add value and help the company grow. The issue with the owner was two things. Number one, very protective of the IP, very protective. I mean, this guy wouldn't even speak, in front of more than two people unless, everybody signs NDAs and so forth. And actually, NDAs, I've yet to see anywhere in this region anybody execute or, penalize on an NDA being breached. But nevertheless, so this particular software, not only did we see value in what this individual has created, but we saw how we, as ADFG, can help him grow the business. So the funding that we provided went into several aspects of the business. But the first and foremost is we needed to expand the team. You definitely cannot run it with a skeleton team. We spent more money on business development and developing the software itself on the platform. And third is we tapped into our own network globally and getting that software out there to developers and real estate owners and asset managers such as ourselves. again, like Abdullah said, people have to understand, everybody has to understand, we're in this for a commercial return. So we're not Khalifa Fund here. So they do things for a different perspective, and God bless them, they do it very well. But for us, we have stakeholders, we have shareholders, we have fiduciary responsibility to our investors that we need to make a certain return.
So for us, yeah, God's blessings are something that we do count upon because what happens is when you're in the startup phase, the global rate of failure, as Mustafa rightly pointed out, is almost 70 to 80%. And if you have a fiduciary responsibility to your investors, you can't handle that kind of risk. For our customers, I would encourage you to download an app of Khalifa Fund. It has got more than 1,000 customers listed. And you'll see them everywhere. They're your regular mom and pop businesses, all the way up to forensic labs and tech enterprises. Lastly, actually another good example would be if you want to look at some of the innovative businesses that we have produced. So you can check Forbes Middle East, last year's edition on startup entrepreneurs. 6 out of the top 10 entrepreneurs in the region are Khalifa Fund customers.
Chandra, let me just refocus that question a little bit for you. Given where the demographics of the region are, where the economy is right now in the region, and where origination opportunities may be, what sectors do you particularly like?
Sure. So I think if you look at the sector, consumer sector still is doing very well here. Again, there are some headwinds which we saw last year and even this year as well. But if you look at the sector that we focus on, sectors that are sort of not so related to oil prices in a way, I think whether it's in UAE or in Saudi Arabia, if you look at consumer, healthcare, education, these are sectors that we believe are defensive and where the performance still sort of holding up to some extent.
Very good. Thank you, gentlemen. So earlier today, what we heard was that there are about 300,000 SMEs in the country, and at the thin end of the wedge, the number of good quality SMEs which meet the criteria that you've just specified might be about 10 or 12,000 such companies in the country. Now, these are companies which are already successful, have a growth path, and may have much more opportunity. We also know that there are 65 commercial banks in the country who are all ready and willing to help those companies at a cost of 4, 5, 7, 8%. And what we understand is that private equity is much more expensive.
Sure.
So maybe Mustafa, help us to understand why.
No, so I'll help you understand from a different perspective.
Why should they come and talk to you?
For many reasons. Let me get to that. So you're saying that the banks are out there and there are 65 odd banks that are able to lend them out money. If that was the case, then very, very few SME companies would come to private equity or VC players. There's multiple reasons for that. What we would offer an SME is more than just money. A bank will offer you money, collateral needs to be paid up. Very little of SMEs have equitable collateral to give for these loans. They have to pay their installment on either monthly, quarterly, whatever it is. And the bank will not provide any further guidance, any further growth, stimulus, or anything whatsoever. That's if the bank is going to lend you. So that's a very big if.
Big if.
Massive if. So part of our business is a debt business. So we have, I run a debt business called Reem Finance. So I sit on the board and I'm an executive director of Reem Finance based in Abu Dhabi. And we do strictly that. We do lending to SME type of businesses, but we don't do it at 4 and 5%. We actually do it at double-digit, mid to high double-digit returns. And we do that because the market, I'm taking the risk. So as a financier, I'm taking the risk of that business. Now, if I flip that to the other side, as a private equity player, as ADFG, not only am I giving you my money at whatever IRR or multiple return I want out of it, but I'm also giving you access to my network, my teams, my hands-on expertise to make you grow and take you to the next level. This is a very, very important distinction for SME owners to understand. So you're not coming to us just for somebody to fund your next phase of development, because that's not what at least that's not what we're all about. So we like to roll up our hands and get involved and take you to that next level. Banks won't do that if they're gonna lend you, which is a very, very critical component. Liquidity for that type of lending is very dry. Abdullah can tell you, more about that. But liquidity in the local and possibly international banks that operate in the UAE for SMEs without appropriate collateral is very limited. So you want to take your company to the next level, I think a private equity firm or a VC for that matter would be very much your suitable partner, because we're a partner moving forward rather than just somebody that's bankrolling your finances.
No, I think he summarizes beautifully. There's nothing I can add, honestly. Well said. And I stress the big if on banks, by the way.
Yeah. Even though this is sponsored by MBAN, let them see.
No, I think I agree with you. I mean, I think from the bank's point of view, you rightly say financing is not that available, and banks are taking, if they do lend, they are taking equity risk or close to equity risk. And point taken about how much value you add. Do you sometimes think that when you're dealing with an SME company, because private equity has a pressure to exit, that can have sometimes a too much pressure on their business model? How do you deal with that situation where there is a pressure for private equity to exit, and does that go hand in hand with the long-term interest of the company, the portfolio company?
Yeah, I mean, I think the timeline is not set in stone, right? It could be anywhere between 3, 4, 7, up to 7 years. So I think, yes, there is pressure and there is discipline that comes with bringing in a private equity investor on board. And if the entrepreneur is not ready for that, or he wants it to remain a family business or a dividend play for him, then we are not the right partner. And ultimately, if the plan or that was put together with our new partner hasn't materialized in 5 years, then something is wrong in that equation, and therefore we should split. But usually the time horizon on exit is fairly flexible, and it's also not a function of just the company; it's a function of the market situation and the macro environment around it as well. So it goes both ways.
I think it's very important for
Sure.
it's very important for the SME owner to understand that private equity investment does not mean that Gulf Capital itself is pitching into its pocket and giving you money, or ADFG for that matter. So essentially, and the norm is that private equity money is coming out of private equity set up funds. These particular funds have something called LPs, limited partners. So these guys have invested for the term of the fund, and they expect to get their money back at the expiration of that fund, give or take a few years of extension. So, I mean, the money trail goes farther than the company that's actually giving you the money, because it's got a fiduciary responsibility to its investors. So it gets a little bit complicated, and it's very important, like Abdullah said, that from the beginning, you are very clear that this is not a marriage. We're not in it for life. This is for a period of time. You have to understand everybody's got to make their return and move forward.
I think I agree with that, and I think the way we do it is, I think there's a lot of educating involved as well, that when you go and talk to entrepreneurs, you have to tell them about, because especially in the region where the P is a new asset class, it's only been 15 years old, so you have to go and sort of tell the entrepreneurs where this is what you're looking for, and your exit horizon is 5 to 7 years. And as we sort of say in our business, that sort of you date before you marry. So before sort of you write the check, you sort of make sure that you both are on the same page, that we are looking to exit the business in 5 to 7 years. So
Just to add, I mean
Khalifa Fund just gives you money.
that we do. But the private equity business, yes, you date, but in the case of a divorce, you end up getting all the money. So the model is slightly different. But the important thing, as my colleagues have mentioned, not every SME is a PE client. Not every SME is even a VC client. So you have to differentiate. Majority of these are lifestyle businesses which will have some cash flow, and will acquire some sort of lending facilities from the banks. They do not have the opportunity to scale or grow at the rate which would make them attractive to a PE firm. And that's the reality. A lot of time I see this confusion, people coming up, I've got a 5 million dirham business, I'm going to 10 million dirhams. You're not a PE business because there's no potential in that. It's a very good business for the entrepreneur, but it just does not interest this side. The other thing on the lending rates, 4 to 5%, I would agree with Mustafa. The last time I heard 4 to 5% over here was the banks giving out on deposits, not lending. It's from our experience, it's double digits plus definitely, and you're looking at about the range is between 12 to 15% if you can get it.
Good. Thanks for clarifying that. So now we understand very clearly the perspective from the PE side and what the criteria are and what's in it for you. The question is, if our audience, who is knocking on the door of a PE, having qualified in the right frame, what do they give up? What's the trade-off for them? What's the equation for coming to you? And let's start, and I'm sure it'll be two different answers because Khalifa Fund will have a different output, but maybe we'll start with Chandra on this one.
Sure. So the way we look at it is, and the way the entrepreneur should look at it is, it's not a trade-off. It's a win-win situation for both the PE fund as well as the entrepreneur. So we bring the capital, we bring our network and connectivity to the table. What the entrepreneur brings is his passion, his expertise, and his business, right? And the way sort of we work alongside is, there's a co-sharing of control, there's a co-sharing of company, and then we both work together to sort of grow the company to take it where it has to go. So the way sort of we position ourselves, or the way sort of we think about it is that an entrepreneur, you can always say that whether he's better off owning 100% of 100, or he's better off owning 60 or 50% of 1,000. So if he runs the numbers, I think he's better off partnering up with somebody and sort of grow the business.
Abdullah, please.
We spend a lot of time with our potential future partner to make him as comfortable as we are with him or his business. We're all sitting here sounding as vulture capitalists. No, actually, and all we care about is making money, which is, we do care about making money, of course. But I think there is merit in the value add that a private equity firm brings to an establishment. And you have to be honest with yourself. Are you ready to bring an outsider into your house? Are you ready to start having board meetings? Are you ready to having people question what you're doing, your decision-making process? And, or is it something that you just want to continue on your own? So private equity is not for everybody. So you have to embrace it, engage it, and be personally comfortable, not only with the organization, but with the people within the organization. Are those people that you can work with over the next 5 years? Because it's not always going to be smooth sailing, right? There's going to be tough times, there's going to be stress on the business, on you as an entrepreneur, and us as an impatient investor. So all that dynamic needs to work, and it's never easy, but ultimately, you have to be convinced that these guys bring more than just money, and they're going to make this business a better business in the future for you and for the next guy after you. Because the other thing we don't want to do is sell businesses that eventually fail, because it doesn't reflect good on us. So continuity beyond our ownership and arguably your ownership is key.
Mustafa, can I just ask you in terms of the process? If let's say you are obviously the private equity investor and there's a portfolio company that you are the owner of, what are the different processes that the portfolio company can expect that they will be seeing from you in terms of, let's say, on a quarterly basis or a monthly basis? Is it just
already like a company that we've already invested in,
exactly?
Sort of thing?
Yeah. From a compliance, is there financial reporting requirements?
So the first and foremost is a corporate structuring. So basically, for us, when we get involved, we're kind of sort of institutionalizing your mom and pop shop, if it is a mom and pop shop, which is very, very important, because institutionalizing a company that's in existence is a little bit tricky and hard, because you're introducing corporate governance, you're introducing, corporate responsibility, you're introducing board meetings, annual reporting, and so forth. So this has to be clear from the onset. Like Abdullah said, from the beginning, when you're defining this relationship, actually, I'll take one step back, and I think the iTagit founder, I think his name is Adham, with all due respect to you, wonderful job. He said it very well, and he kept repeating it, is what is it you want to do? And if it's something that you can do alone, you can't do it alone. If you can't do it alone, then you're coming for somebody to help you in that journey. And it doesn't come cheap, it doesn't come free, and it's not only about money, but it's about the entire sort of institutional structuring of your entity. And it's all to the better. If that's something that you want to take the next step in the evolution of your business, then you must be prepared to do that.
Can I add something? I think one thing that should not be misinterpreted, we don't want to run the business. We are not day-to-day operators. So we're very conscious about that. The idea is not to intrude or get involved in the day-to-day running of the business. There's a strategy, we set the strategy together, there's a business plan, and there's an annual budget that is to be met. But at no point will we pretend or believe that we can run the business better than you, that you've been doing it for many, many years before. So it's more about guidance, strategic assessment, and kind of value add, but don't want your job. It's your job, and we're investing in you and your team to take this business to the next level with the resources that we make available to you.
But reporting is very important.
Sure.
And that's how you keep track.
And
Sure.
so just to add on, there are two things. One is the reporting, and one is you look at the company's internal processes as well, right? How they're tracking their customer experience, ERPs, and all. So when we come in as a PE investor, we make sure that even these things which are more operational related, company somehow improves it going forward. So.
Great. Thank you very much. So just to sum up very quickly, private equity comes in for companies that are at the growth stage. You're looking for very strong managements. Typically will not do turnarounds, typically will not do startups. At the moment, defensive sectors are attractive given where we are in the economic cycle. You know, in terms of what value private equity adds, clearly there's corporate governance, there's processes, there's financial reporting, and there's strategy to take the company forward to its next stage of development. It's not, private equity is not cheap, but we've talked about the reasons why, because you're taking a lot of risk, and frankly, if banks want to take the same risk, they should probably be charging more like what you do. So I think that's how I would sum it. Thank you very, very much. Very interesting
Thank you.
insights. Thank you so much.
Thanks.
Thank you.
Thank you.